Good afternoon. On behalf of the entire Greencrest research team, it's my pleasure to welcome you to the latest installment of Greencrest's monthly webinar series on the digital media, social media, and e-commerce sector. Today we will be discussing the biggest topic in the space. In fact, it's the biggest topic pretty much anywhere you look, and that of course is the Facebook IPO. This is the most widely anticipated IPO in recent memory, and the media hype ahead of Friday's trade date, which we expect to drive substantial volume, is nearly unprecedented. And that's really the impetus for the title of today's talk, which we've called The Storm Before the Storm. So thank you again for joining us. And let's move on to slide 2. Here we have our disclaimer that we use for all our webinars and our research. You can peruse it here, but it's also available on request for anyone who would like a copy of it. We'll move on to slide 3 now. Just to review today's discussion, the presenter is myself, Anupam Palit. I am a senior analyst and I'm the head of research here at Greencrest. Greencrest specializes in covering late-stage leading private companies. That is really where our expertise is. We're often the first or only analysts on some of the leading private companies, and to the extent that you might be interested in learning more about private companies, you want insight or access into leading private companies, we would love to be your primary source of information and access to these companies. The topics for today, of course, with respect to Facebook. First of all, we'll talk a little bit about the storm before the storm and what we mean by that. We'll ask what makes Facebook such a compelling investment opportunity. We'll ask what it needs to prove to become more attractive to investors over time. We'll talk a little bit about valuation, and we'll talk about life after Facebook's IPO. After our prepared comments, after the prepared comments, we're going to take some questions from the audience. I think in your screens that you have as part of this webinar, there is a box that you can ask questions in. So feel free to type them into that box as the webinar is going. You don't have to wait till the end. The questions will queue over the course of the webinar, and at the end of it, we will answer as many questions as we have time for. So let's move on to slide 4 and get into the formal comments that we have prepared. So here are just the facts behind the Facebook IPO. It's due to price the IPO on Thursday evening and begin trading on Friday. The indicated range on the S1 right now is $34 to $38. Recently raised from $28 to $35 per share. The valuation at the high end implies a market cap of $105 billion. Also at the high end, the offering represents an $18 billion raise. That includes the over-allotment. And the overall raise is about a 40-60 split between the company and existing investors. The over-allotment is 15% of shares, and 95% of the green shoe is existing shareholders. Key sellers in the offering, Mark Zuckerberg. Of course, he has to sell some shares to handle some tax issues related to the vesting of options. No other management is actually selling in the offering, no other senior management. You've also got some VCs who are selling part of their stake, not their entire stake in the company, but a portion of their holdings. Now, that includes Accel, Greylock, DST, Elevation, Meritech, and Tiger Global, among others. We'll move on to slide 5, and this is really what we mean by the kind of the title that we have for the presentation. We do expect Facebook to take the market by storm on Friday and drive substantial attention and volume. Over the last several days, however, the media circus has been kind of in full swing with stories about Mark Zuckerberg's attire, the way that one of the lead underwriters decked out their offices for the roadshow presentation, the ridiculous jackets that they wore in front of investors, all these kinds of things. What we're trying to do is go kind of behind closed doors and get feedback directly from the roadshows, talk to people, look at the fundamentals of the company, and really find out what investors are concerned about and what they're excited about. And really what we want to do is narrow down to kind of the key points here. What investors are really excited about are, first, user growth, second, strong engagement, and third, international revenue opportunity. What they're worried about is the slowing ad revenue momentum, the mobile monetization, and how Facebook credits is going to end up looking over the long term. So really there's three big compelling value propositions, and there's three things that Facebook needs to prove. So let's go into each of these. So the first compelling value proposition is the tremendous growth in users. And the slide, I think, really speaks for itself. In just over 3 years, the company has grown from below 200 million users to over 900 million users. As we can also see by this chart, the company enjoys significant geographic diversity in its user base. You're seeing growth and existing users from all over the world in all the major regions that they report. The second compelling value proposition, so number 2 here, is the strong engagement characteristics. There are many ways to measure engagement. Engagement is kind of like, like a term like justice. It defies kind of, pure, simple explanation, but it's basically the idea of how engaged your user base is, not just how many people have signed up for the service. And here we measure it by taking daily active users as a percentage of monthly active users. Of course, the higher the better here, as it effectively shows repeat usage patterns among active users. And so we can see that all the regions that Facebook reports have been moving up and to the right over the last 3 years. And of course, that's certainly a positive sign. We can see that North American engagement has leveled off. Europe appears to be getting very close to leveling off, and in Asia and the rest of the world, it's still trending up and to the right. So overall, very strong engagement characteristics, although we are seeing a leveling off in the quote-unquote Western world. We'll move on to the third compelling value proposition that we have for the company. And that is a growing international revenue opportunity. And so what do we mean by that? First, we've already talked about the right side of the slide, which refers to the high geographic diversity in the user base. So certainly when we think about the 4 geographies that Facebook reports, US and Canada, Europe, Asia, and the rest of the world, we can see that they have a very diverse geographic split of monthly active users. The left chart actually shows the average revenue per user by geography and the growth associated with each of these regions. So we can see that right now, North America and Europe monetize much higher than the other regions. The problem, of course, is that they account for less than half of the users right now and actually becoming a smaller proportion over time. The upside opportunity, however, is the growth rate in this average revenue per user, which in Asia and the rest of the world is in the 20 to 30% range versus 15 to 17% range for the quote-unquote Western world. So what's happening now is that increasing portion of the user base is coming from the lower ARPU geographies right now, but those geographies are growing much faster than the traditional geographies, US and Canada and Europe, which accounts for most of the revenue right now. So part of our thesis is that we do believe that the company is going to be able to continue to see revenue growth and aggressive revenue growth on a per user basis in markets outside of the US, Canada, and Europe. So let's move on to the key risks. So the first is that, what does Facebook have to prove? And the first thing that we want to talk about is that they have to prove that ad revenue growth can remain strong. The big takeaway coming out of the first quarter with respect to revenue was that revenue growth, was much slower than it was previously. And of course, we do have, the law of large numbers kicking in. But what we want to, really make sure that people understand is that this was not just a case of the law of large numbers. So let's look exclusively at advertising revenue. This does not include credits revenue, which continues to grow very strong. This is just ad revenue. So we can see that the incremental number of advertising dollars that Facebook added on a year-over-year basis in the first quarter of 2012 was actually lower than the equivalent number in the first quarter of 2011. So in other words, from first quarter of 2011 to the first quarter of 2012, the company added $235 million in ad revenue. If you look at first quarter of 2011 versus the year-ago quarter, which is the first quarter of 2010, they added nearly $300 million in ad revenue. So it's not just that the growth is slowing. The incremental dollars that they added in that period versus the year-ago period was actually lower. So it's not just the growth rate issue, it is that less money came in. We have heard from investors, and we do expect investors will want to see that ad revenue momentum can remain very strong over time. The second item that we believe that Facebook has to prove is that mobile is in fact monetizable over the long term. So let's look at a couple of quotes from the S1 here, which is the first thing that they mentioned, that we believe our ability, and again this is from the S1, so we meaning Facebook, we believe our ability to compete effectively depends upon our ability to successfully monetize mobile usage. And shortly thereafter, they mention our advertising revenue could be adversely impacted by increased user access to and engagement with Facebook through our mobile products, where we do not currently directly generate meaningful revenue. So this is kind of the basic dilemma. More usage is going mobile, but they don't monetize mobile all that well. Now, let's be fair to Facebook. No one really monetizes mobile all that well. This is an opportunity that has, I guess you could say, has underperformed for a couple of years right now. When we think about mobile advertising overall, and we actually did a webinar a few weeks ago strictly on mobile advertising, and this is something that you have to believe for the future is going to take hold. Right now, mobile advertising really has not quite taken off yet, and we're still seeing a lot of companies, whether it's social networks, content providers, actual advertisers themselves, publishers, the networks, all trying to figure out exactly how this landscape will evolve over time. So it is still very early. What we believe is going to happen with respect to Facebook is that there will be a pain period where under-monetized mobile usage will grow faster than the highly monetized desktop usage. So they're going to have to go through that transition phase where more and more users are being added to the lower ARPU, the under-monetized part of the business. But over time, we believe that mobile advertising will be able to catch up to desktop advertising. And there's two ways that this is going to happen, and these two, I think, are going to happen in conjunction, which is the first, that mobile and desktop CPMs will converge over time. Currently, mobile handset CPMs are about 50% of desktop CPMs, and that's kind of industry-wide on average, while mobile tablets have about 75% of the CPMs of desktops. We believe that the CPMs on handsets will continue to be much lower than they are on desktops. So we do believe that mobile CPMs on tablets and the desktops will slowly converge over time. The second key thing to mention is that there will be an increasing number of ads in the mobile experience. And again, this is where tablets really come in. On the handset side, from a logistical perspective, adding in, well, even if it's sponsored stories or very small banner ads, is very difficult to do within the context of the newsfeed simply because the screen is small. On the tablet, we can actually see a much better example of the desktop experience being available on mobile. So we do believe there will be more ads in the newsfeed on mobile, and those CPMs will slowly converge with the desktop CPMs. The third thing that Facebook has to prove, in our view, is that there's more to credits than Zynga. So first of all, let's think about Zynga. Zynga is a 15% customer. 11% of the first quarter revenue in the first quarter 2012 revenue was from the revenue share of Facebook credits and direct Zynga advertising. Another 4% of Facebook's revenue in the first quarter was from ads placed on pages generated through users playing Zynga games. So 15% of Facebook's revenue is from Zynga. And essentially all of the revenue from credits is basically Zynga. There's nothing really else. A lot of stores have actually shut down or have adjusted their commerce initiatives that redirect outside of the Facebook platform and don't necessarily use credit. So think about stores actually shutting down. Nordstrom, GameStop, JCPenney, Gap. These are examples of companies that have actually taken their stores down because they weren't really seeing the kind of engagement that they were hoping to see. Stores like 1-800-Flowers.com and Nike, if you go to those kind of pages and you go to the store, it actually takes you to a separate experience outside of Facebook. So you're now on the Nike store or the 1-800-Flower store. You're not within the context of Facebook anymore. So storefronts are trying to figure out exactly how to use Facebook and whether or not a commerce activity on Facebook is really the way for them to go. I think that investors really want to see that there is a true e-commerce opportunity on Facebook right now. And it's not going to be just kind of lead generation or likes. It has to go beyond just likes. There has to be true commerce on the Facebook platform. So investors are looking to see that. So now that we've gone through these three, let's move on to some thoughts around valuation. We continue to believe that a fair value for the company right now is $75 to $85 billion. This implies approximately $27 to $31 a share. We've built our valuation based on a DCF analysis. Now, in terms of how we think it's actually going to trade, we believe that it will trade at or above the current high end of the 34 to 38 range. So we think it prices very aggressively, $38, $39, $40, and trades very strongly well into the 40s on the first day. But we believe that fair value right now is $27 to $31 a share. Incidentally, some people have asked us, why are you so negative on Facebook? Why do you believe $75 to $85 billion? What do you think is wrong with the company? And, look, we've gone through the positives and the negatives here over the last several minutes. At the end of the day, we do believe in the Facebook opportunity, and we do not believe our valuation, which is 20 to 22 times trailing revenue and 14 to 16 times forward revenue, could be considered bearish or negative. We think it's actually, a pretty fair valuation, all things considered. And so we don't believe at all that it's bearish or negative. Can Facebook grow into a higher valuation? We believe that yes, Facebook can justifiably become a $100 to $150 billion market cap company over time. We're saying not yet. We're not saying it can't get there. We're saying not yet because there's execution risk. As analysts, we're always trying to find that balance between looking forward and discounting future cash flows and looking what the opportunity is. But of course, the company has to execute against those expectations. So we do believe that it can achieve those. And we do believe that it will be a key long-term holding for investors in the space. But in order for us to get more excited about valuations at the high end of the range or valuations above the high end of the range right now, we believe investors are going to want to see progress against the concerns that we've outlined here in the last few minutes, namely those three things that Facebook has to prove. As we see evidence and we see proof that Facebook is making real strides and progress against those risks, as we see that happening, we think that there's going to be room for valuation upside over time. So now that we've gone through the valuation, let's think about life after Facebook. Whatever happens on Friday, the sun's going to come up on Saturday, and the market's going to open Monday morning. And the day that Facebook trades is going to come and go. After that, we do expect a strong IPO market over the next 12, 18 months. We do think there's going to be a lot of other companies that are looking to potentially file. And we've given a few names here. We have research on a bunch of these names, on a number of these companies. To the extent that you might be interested in learning more about these companies or wanting to have a conversation about the opportunities around some of these companies, we encourage you to contact us and get in touch. But the main point I'm trying to make here is that there are going to be a number of very exciting companies that are looking to file through 2012 and perhaps early in 2013 as well. So the next 12 to 18 months, we believe, will be a very active IPO market. With that, that pretty much closes our formal remarks. I'd like to open it up to questions right now, to the extent that any of you have questions. Before I do that, I do want to encourage you to stay in the conversation with us. You have our website there, greencrestcapital.com. Our Twitter handle is @greencrestcap. You can follow me at @akpallet. Our email is greencrest.research@greencrestcapital.com. It's a bit of a mouthful, I know, but there's all our contact information. We encourage you to stay in touch with us. And to stay in the conversation with us. We'd love to get any feedback from you, to continue to talk to you, and so we please encourage you to reach out to us and to continue the conversation. So we're going to take a couple of seconds right now. We'll take about 30 seconds to just continue to compile the Q&A roster. There's already questions that are floating into the Q&A right now, but we'll wait a couple of seconds to get some more questions in, and we will get to as many questions as we can. So give us about 30 seconds, and we'll get right back to you. Okay, great. There's one logistical question that I'll just get to very quickly before we get into the actual substantive questions. The first question was, will there be a replay available? And the answer to that is yes. The replay will be available. You also have our contact information there, that if you'd like a copy of the slides, we'd be very happy to send you a copy of the slides as well. So from a logistical perspective, that's the That's the answer to that. We have a question here. Is the recent GM announcement that they're withdrawing their advertising with Facebook a non-issue, or could it be the tip of the iceberg and a sign of real problems with monetizing the 900 million user base? It's a great question. What we think is that I would say that we've outlined the risks here in terms of why we're not entirely comfortable with the valuations that we're seeing right now at the high end. So there are a number of reasons why we're not comfortable at the valuation, but that is not one of them, to be perfectly frank with you. In our view, and this is the same thing with everybody, there are advertisers who come and go from the platform, and there are advertisers who see value to a particular campaign and ones that don't. So, in our view, the GM, we don't really know why GM didn't see the value. There could be a number of reasons. It could have been their campaign itself. It could have been that it doesn't make sense for the Facebook platform, that they couldn't provide the value. And you also have to remember that the promise of advertising on Facebook really is this idea of social commerce, or F-commerce as they call it. The idea that the social interaction is going to be an important part of purchasing decisions. So when you think about the type of people that shop together, or that do things together, people shop together, they go to bars together, they go to restaurants together. It's quite conceivable that people don't go buying cars with their friends. That tends to be a more family decision. It tends not to be something that people do a lot of online in terms of getting feedback as much in terms of the purchase decision. So it's possible that automotive may not be a big category for them over time. It could also have been something specific to the Facebook platform. But the idea is that a single advertiser, no matter how large, pulling their advertising for a certain period, I don't think that is enough to get negative on the company. Although the timing is, a little bit suspect, to be perfectly frank. But we do believe there are risks to owning Facebook at the levels that they're talking about. But we do not believe that the GM pulling the advertising, amounts to a kind of an existential risk to the company. We have another question here talking about what is the potential commerce opportunity over the next several years for Facebook. It's a very good question. We do believe that a lot of people will go back to adding storefronts over time. It's going to be a question to us about how annoying it's going to be for users to pay through credits if they want to make quick purchases versus being able to buy things without credits, and what kind of revenue share that the Facebook is going to demand over time. So when you think about a company like Zynga, and you think about the fact that they follow this 30% rule, which is that all Zynga, anything that's purchased on the Zynga platform has to be purchased with Facebook credits, and anything purchased with credits, 30% goes to the house, so to speak, goes to Facebook right off the top. So what that essentially means is that Facebook is going to take 30% of any economics that you purchase through Zynga. And is that going to be a suitable monetization arrangement for big retailers like JCPenney, like Nordstrom, right, like Gap? And our answer to that is no, quite frankly, that they're not going to be willing to hand over 30% of their economics to Facebook. So we believe that Facebook is has gone through an experiment with the storefronts. It didn't go all that well, although some companies are seeing some value there. We do believe that the storefronts will come back, but they are going to have to adjust the way that they monetize that revenue opportunity. We have a question here about acquisitions and what we think about some of the recent acquisitions that Facebook has done. We believe that acquisitions are going to continue to be part of the game. We do believe that Facebook looks both at building internally and looking externally, and I think that they're both acquiring on both fronts. So what that means is they're looking to acquire companies that could provide them with either engineering talent or with services that they want. We also believe that they're looking to acquire people by taking them from other companies, whether it's Google, whether it's Apple, whether it's anybody else. So in terms of actual hiring talent, I think that pretty much speaks for itself. They'll be looking to find people at larger organizations and hire them over, or buy small organizations with small engineering teams and may not have as much interest in the product itself, but really in the engineering team. So somebody like Gowalla, for example, is probably more interested in the engineering team, although some of those services could play into some of the location-aware services over time, but primarily looking at an acquire strategy there. On the other hand, when they're looking at acquiring companies for some kind of product or service, they're going to be looking to fill in a gap. When you have 900 million people on a platform, you lose this idea of a small, passionate audience. It's the difference between going to a concert at a huge venue versus going to a small, intimate venue. There's something special and unique if you're a guest at a small and intimate venue, and you kind of lose that when you get to 900 million people. And so a company like Instagram that they bought, Instagram brings a passion audience and it brings them into mobile, right? So there are going to be opportunities for them to continue to acquire and to pursue inorganic growth opportunities. Question here about how the long-term geographic revenue split relate to the long-term geographic user split. Over the next, I guess, foreseeable future, in the next few years, we do believe that North America and Europe will continue to account for the majority of the ARPU, will be the highest ARPU. We do believe that the other geographies like Asia and the rest of the world will grow faster, but it will take time. A very long-term point of view, we do believe that there will be a little bit more kind of mirroring in terms of the geographic split in ARPU and the geographic split in the actual users, but we do think it's going to take a lot of time before the average revenue that the company receives from Asia is kind of proportionally the same as the number of users from Asia. That is going to take a long time. That is not something that we would kind of expect in the 3 to 5 year period. We think it's going to take much longer than that. So for the foreseeable future, I think when you're thinking about where the primary monetization opportunities are, it's going to continue to be in the U.S. And Western Europe in particular. We have another question here in terms of, do you expect engagement to plateau in non-North American regions? We believe it has to. We believe that it has to over time. And incidentally, we don't believe that's negative in and of itself, in the sense that we at a certain point, you simply cannot continue to grow at robust rates. When you're talking about nearly 1 billion people on the platform, there is a certain kind of natural growth that is going to tail off, and there's only so much that you're going to get natural kind of engagement level. So we do believe that we've essentially seen a plateauing of engagement in North America. We do believe that Europe is going to essentially plateau in the very near future, and we do believe that over time, call it the 3 to 5 year time frame, we will see a plateauing in engagement in Asia and the rest of the world. Now, that we do not believe is a negative in and of itself, because the true growth opportunity for Facebook, of course, is the average revenue per user. And so we want to continue to see the average revenue per user growth. So it's not just that they have to continue to just drive people to the platform. In fact, that's probably what you don't want to do. What you want to do is monetize those people better. And what does that mean? First of all, it means they have to get better at organizing and presenting data. It sounds very easy to say that, well, there's 900 million people share information, they should be able to take that, turn it around, and sell it to an advertiser. Now, in principle, that sounds very nice and easy to do. In practice, it can be very difficult. Some of the data is unstructured. The data is complicated to parse. You have to use very advanced tools. They're in the process of doing that, but the feedback we get right now from advertisers is that, when I spend $1 on Google, I know exactly the audience that I'm going to get. When I spend $1 on Facebook, I don't exactly know the audience I'm going to get, although I know that a lot of people are going to see the ad. So this is kind of consistent feedback that we get. So we do believe over time Facebook has to improve its kind of audience targeting capabilities. So that's the one thing. The second thing is, this is why it's so important for them to be driving commerce on the platform. This is why it's so important for them because to be driving real purchases from places like Gap and Nordstrom and JCPenney over time, because they can't just rely on adding more and more people to the platform every single month and every single year. At some point, that has to plateau. So we do believe it will plateau, but we don't believe it's a negative in and of itself. The company does, though, have to show progress in executing against the strategies of continuing to improve ARPU and to drive real commerce on the platform. Question about whether we think that the company might be gaming some of the Q1 revenue or the Q1 results, potentially to set themselves up for a Q2 and a Q3 beat. Look, I mean, this is always one of those things where companies are going to try to put themselves in the best light at the right times. There's nothing sinister or odd or weird about that. That's what companies do. What I would say is that it is a little bit tough to game in terms of ad revenue and credits on the platform. It is a little bit difficult, and if they were doing it in a certain way, it would be very tough for us to know about it. In our view, the Q1 results are what they are, and we do believe that there was a meaningful slowdown in the first quarter results. We believe that the company will, and especially because that is the last quarter that is being reported before they go public, we do believe that they did try to put themselves the best possible light as anybody else would, but we do believe it's a big concern that they slowed down. They will message the street, and I think that they will, like every other company, put themselves in a position that when they report the Q2 and the Q3 numbers like everybody else, that they will try to manage expectations in a way that when they report, it makes them look good. And again, that is not sinister or odd. That is what all companies essentially do. But I don't think that we're seeing too much gamesmanship right now. We are seeing in a separate kind of media circus like we talked about, but in terms of the fundamentals of the business, we are concerned about the Q1 slowdown, and we do expect the company to begin very actively messaging the street pretty much immediately after the IPO. There are a lot of questions in the queue. We'll try to get back to you individually later on this afternoon to the extent that we have kind of your names here and your contact information. Also, if you do want to ask us a question, please feel free to email us or to call us, and we'd be happy to chat with you further. So that's pretty much all the time we have right now in terms of the questions. But again, we really invite you to stay part of the conversation. We want to continue talking with you. A lot of you, I noticed, are on our webinars very regularly, and we appreciate your support. So again, thank you very much for your time this afternoon. We really appreciate it. And please feel free to reach out. And we look forward to hosting you again in about a month or so on our next webinar. Thank you very much.